We'll now move on to reading 30 of the CFA curriculum, which deals with the accounting for long-lived assets like plant and equipment, intangibles. So we'll begin with understanding when an expense should be capitalized on the balance sheet and when should it be expensed on the income statement. We'll move on to understanding the accounting for intangible assets, review the concepts of depreciation and amortization, understand asset impairment and revaluation, and wind up with the accounting for assets held for sale, derecognition of assets, and the accounting for investment property. Now, expenses can either be capitalized as an asset on the balance sheet or they can be expensed in the income statement as a cost. The decision essentially depends on the matching principle, which we studied earlier, tells us that expenses must match revenues. So let's assume that it takes me 2 years to construct my factory, over which I spend $100 every year on equipment, another $50 on the civil construction, labor, etc., and $10 each year on the interest during the construction period that is due to the bank. Now the question is that should these $160 of costs be expensed in year 1 and year 2, or should we store them and expense them later in year 3 when the revenue starts coming from the plant? Because in year 1 and 2 the plant is not under operation. So if I expense these costs, I would incorrectly be penalizing the revenues of year 1 and year 2, as the matching principle says that the cost of this plant should be attributed to the revenues coming from this plant, which will start from year 3 onwards. So the matching principle and accrual accounting tell us that these costs should be capitalized on the balance sheet and attributed to the periods in which the revenue is coming. This is the concept of depreciation that we studied earlier, the allocation of the cost of the plant in the periods in which it is earning revenue. So let's revise. That expenditure that is expected to provide a future economic benefit over multiple accounting periods is capitalized, and if the future benefit is unlikely or it is uncertain, then to be conservative we will expense it in the period that the expense has been incurred. However, these expenses that we depicted should be capitalized because the benefit is coming later. An expenditure that is capitalized is initially recorded as an asset on the balance sheet at its cost. The cost is then allocated to the income statement over the life of the asset as the concept of depreciation or amortization that we studied earlier. If the cost is immediately expensed, however, then the pre-tax income will get reduced by the amount of the expenditure. So let's understand an example. C Estate Company purchased new equipment to be used in its manufacturing plant. The cost of the equipment is $400,000, including $4,800 in freight and $14,000 of taxes. In addition to the equipment cost, C Estate paid $15,000 to install the equipment and $6,700 to train its employees to use the equipment. Over the asset's life, C Estate paid $33,300 for repair and maintenance. At the end of 5 years, C Estate extended the life of the asset by rebuilding the equipment's motors at a cost of $95,000. What amounts should be capitalized on the balance sheet and what amounts should be expensed in the period incurred? Remember, expenses that will bring benefit in the future should be capitalized and others should be expensed. So this $400,000 of the cost of equipment, inclusive of the freight and taxes, is going to bring me benefit in the future. So I should capitalize it. So amongst the costs capitalized, first would be that of the plant, that is $400,000. The installation cost is also a one-time expense that is going to provide benefit in the future, so we will capitalize the installation cost as well. Please note that employees can keep coming and going, and these training costs may become a recurring feature, and even if they are not, these costs are not required to bring the asset to its current shape and form. So generally we do not capitalize training and education expenses for whatever purpose they may have been spent. So the $6,700 will be expensed in this period. Similarly, repair and maintenance does not increase the useful life of the asset, and it may be required in the next period and possibly on a recurring basis. So even this $33,300 will be expensed. The $95,000 paid for extending the life of the asset clearly will provide future benefits. So these costs should not be expensed in that period that it was incurred. It should also be attributed to the period over which the asset is being used or the extended life. So we will capitalize the rebuilding expenses for the motor to the tune of $95,000. So over the life of this plant, about $510,000 should get capitalized and $40,000 corresponding to training and repairs should be expensed. Now please remember that interest cost during the construction period is treated the same way like the cost of plant and equipment. That is, the interest that accrues during the construction period is capitalized as a part of the asset's cost. And the reason is the same, that this will accurately measure the cost of the asset, since interest, installation, taxes have all been spent to bring the asset in its current form and condition, and expensing it during the period of use better matches the cost with the revenues generated by the asset. Please remember that only the interest on construction costs and during the construction period is capitalized. Interest costs on general corporate debt are expensed. So like all other initial costs, capitalized interest is not reported in the income statement as interest expense, but is added to the cost of the asset, and subsequently this cost is represented in the income statement through depreciation expense or cost of goods sold if the asset is held for sale. And even though generally interest expense is a cash outflow from operations, when capitalized, this will add to the cost of my plant and machinery and it will be reported as a cash outflow from investing. So let's understand the effect with an example. So we've been given the balance sheet for ABC Incorporated, the asset side, as well as the liabilities and equity, and the income statement. We are further told that during 2012, the company capitalized $40 of construction interest. The capitalized interest increased depreciation expense by $10 for the year. For analytical purposes, you have decided to treat the capitalized interest as an immediate expense. So you think that the company is trying to manipulate the income statement and show higher profits by capitalizing costs and not expensing them in the period incurred. You think that this debt is for general corporate purposes, and you think that this entire $40 should be expensed in this period. So you're going to restate the statements and calculate the ratios again. So complete the following table, ignoring any income tax effects. So these are the metrics as currently reported. The total assets, interest coverage, net profit margin has been calculated from the previous statements and presented here. We need to first construct the adjusted accounts, assuming that this $40 is expensed right away, and then compute the ratios again. So let's first restate the income statement. So whether I expense or capitalize interest, will my sales change? No, so sales remain the same as 5,000. The raw material expenses or the cost of goods sold will also remain unchanged, and the gross profit will also remain the same. The operating expense includes SG&A, and it also includes depreciation and amortization. Now we are given that depreciation expense was higher by $10 in this year because of the capitalization that we've done. If we undo that capitalization, the depreciation expense would have been lower to the extent of $10. The interest expense would be higher, but that will come later. As far as operating expense is concerned, it would be lower to the extent of $10, or it would be about $490, giving us an operating profit that is $10 higher. The interest expense, however, will be higher by $40 since I'm capitalizing nothing and expensing the entire costs in this period. So the earnings before taxes would become $870, that is $30 lower. Taxes we are asked to keep the same, So the net income would now only be $670. And if we assume the same dividends of $100, the retained earnings would not be 600 anymore. They would fall down to a number of $570. So that was about adjusting the income statement. Let's now try to adjust the balance sheet. So we'll start with the assets side. So whether we capitalize or not, the current assets will not be affected. So the cash, receivables, inventories will remain just the same. The property, plant and equipment on a gross basis would have seen an addition of $40 because of the capitalization. And we depreciated $10 of the same. So on a net basis, property, plant and equipment at the moment would be higher by about $30. So if we are to reverse the effect of the capitalization, we'll have to reduce the net property, plant and equipment by $30. So this will be only about $1730 now. The accumulated depreciation would become $430, and the gross property, plant and equipment would become $2160. The difference giving me $1730 of net property, plant and equipment, or the total assets would come down to $2820. The balance sheet must always match. So let's see the adjustments that need to be made on the liabilities side. The current liabilities will not be affected. Payables, short-term debt, current portion of long-term debt, deferred taxes would all remain the same. Common stock, additional paid-in capital would also not be affected. The retained earnings, which were earlier of $600, we now just calculated would only be to the tune of $570. So this number would not be 800 anymore. It'll only be 770, or the shareholders' equity would move down to 1470, and the total liabilities would move down to 2820 in line with the total assets. So now that we've restated the financial statements, it's 90% of the job done. We can simply calculate the ratios as are asked in the question now. So total assets we just calculated would be 2820. The interest coverage ratio is defined as the EBIT upon the interest. So this will come from the income statement. The EBIT, or operating profit, now is 1010 upon the interest of 140, and that is 7.21. The net profit margin would be 670 divided by 5000, or 13.4%. Now please note that the total cash flows don't change from our choice of accounting method, but the classification between operations and investing will get impacted. So at the moment, a $40 of cash outflow was being recognized as an investing outflow because it was being added to the cost of our asset. However, this 40 will now be recognized as an interest expense, which is an operating cash flow. So from an investing, we need to reclassify it as an operating cash outflow. So the cash flow from operations will reduce by $40 and will now remain only $650, whereas the cash flow from investing will go up by $40 and will become $160 net outflow. The total cash flow remains the same. The cash flow from financing will not get affected and will also remain the same as was before. The debt has remained the same, and the equity, as we saw, has come down. So the debt to equity ratio should also go up and can be calculated as the long-term debt upon the equity, that is 750 upon 1470, as 51.02%. So please remember that if you expense rather than capitalize, the total assets will go down. Since you're not adding anything to the assets, you're taking all the cost on the income statement. The interest coverage ratio will go down as your expenses go up. The net profit for the same reason will come down. The cash flow from operations will reduce, as the cash outflow is not going to be from investments anymore. It will be an outflow from operations. The cash flow from investing will go up and the total cash will remain unaffected. The debt equity ratio will also go up as the debt remains unchanged, but equity will reduce. So you can verify your answers. So we'll try to compare the effects of capitalizing versus expensing and tell as to where would each of these items be higher, in capitalizing or in expensing. So total assets, as we saw, would be higher in capitalizing as the costs get added to the assets and depreciated later. Shareholders' equity likewise will be higher in capitalizing since the expense is deferred. Income variability would be higher in expensing, because please understand, there would be one big expense in the first year and then no expense in the case of expensing. Whereas in the case of capitalizing, there is no lump sum expense coming anytime. There will be a constant depreciation coming for an extended period in time. So variability would be higher in expensing and lower in capitalizing. Net income in the first year would be higher in capitalizing, but in the subsequent years will be higher in expensing, because in subsequent years there will be a depreciation expense coming for capitalization. Cash flow from operations will be higher for capitalizing because the cash outflow will be taken as an investing outflow, whereas cash flow from investing will be higher for expensing since the expenses are taken as an operating cash outflow for expensing. The debt to equity ratio will be higher for expensing, as the debt remains the same in both methods, but equity will be lower for expensing. Interest coverage, that is EBIT upon interest, would be higher in capitalizing in the initial years as the expense is not shown in the income statement, whereas in subsequent years there will be no depreciation expense coming in expensing. So in subsequent years it will be higher for expensing. Let's now review the concept of intangible assets in more detail. So as we studied, intangible assets are long-term assets that lack a physical substance. For example, patents, brand names, copyrights, franchises, trademarks, etc. Just like tangible assets, the costs of a finite-lived intangible asset is amortized over its useful life. We'll study this with an example very soon. And for indefinite-lived intangible assets, for example, goodwill, these are not amortized but tested for impairment annually, and if impaired, there will be a loss in the income statement as in the case of asset impairment, which we'll study soon. Now, as per IFRS, an identifiable intangible asset is one that is capable of being separated from the firm, or it arises from a contractual or legal right, for example, a patent or a copyright. It should be controlled by the firm. It is expected to provide future economic benefits, and its cost can be reliably measured. Only if all these four conditions are satisfied would we call the asset an identifiable intangible asset. An unidentifiable intangible asset, on the other hand, cannot be purchased separately and may often have an indefinite life. For example, goodwill, that was the excess of the purchase price over the fair value of identifiable assets. Now, how the accounting for intangible assets is done depends on how the asset was created. So if the intangible asset was created internally, then most of these costs are generally expensed as incurred. So if any patent, copyright, or trademark was internally created, then it would not come on the balance sheet. It would have been expensed as and when I spent those costs. Some exceptions include research and development costs. So what IFRS says is that if the research is for a scientific discovery or a new technical knowledge, then these costs should be expensed as incurred. So if I'm saying that I want to find a cure to cancer, or I'm investing money in other such discoveries, then there is no guarantee that a future revenue will come from these expenses, and hence, to be prudent, we expense these as they are spent. IFRS does, however, allow us to capitalize development costs. So these are incurred after the scientific and technical feasibility has been established. So this is the cost required to translate the research findings into a plan or design of a new product or process. So I have developed the molecule or a drug, and now I'm trying to figure out that should I give it in a suspension form or a tablet, or what is the delivery system. So those development costs are allowed to be capitalized in IFRS. Under US GAAP, both research and development costs are generally expensed. So no capitalization is allowed except for software development costs. Where under both US GAAP and IFRS, for software for sale, The guidelines say that any costs incurred should be expensed until the product's technological feasibility has not been established. So just like in the R&D, till the time I haven't found anything concrete, I will expense the costs. The development costs or production costs after the technological feasibility has been established are allowed to be capitalized. So this is the same for both IFRS and US GAAP. If software is not meant for sale, rather the software is being developed for own use, then the IFRS treatment remains the same. However, US GAAP allows to capitalize all research and development costs, whether or not technological feasibility has been established. But for that, the software has to be for own use. So let's do an example to help us try and remember. Over a 12-month period, Crown Development Corp expended $4,000 per month to develop software for own use. For the first 4 months, Crown could not estimate the probable future benefits of the expenditures. Over the remaining 8 months, the expenditure met the capitalization criteria for identifiable intangible assets in accordance with IFRS. That is, the technological feasibility was probably established and the remaining 8 months were more of post-development. The software was completed on time and is in use today. What amount of software expenditures should Crown capitalize under IFRS and US GAAP? So under IFRS, till the time the technological feasibility was not established, all costs should have been expensed. So for the 4 months, the $4,000 that he was spending per month should have been expensed. And the remaining 8 months when he was developing the product can be capitalized. So $32,000 worth will be capitalized and $16,000 would be expensed in IFRS. Please note, in US GAAP, otherwise we are more conservative. That is, we expense rather than capitalize. But for software for own use is the only exception where US GAAP asks us to capitalize all expenditures before or after technological feasibility. So the entire $48,000 in US GAAP will be capitalized. If the intangible asset has been separately purchased, so if we bought a copyright or a patent separately, then like any other tangible asset, it will be recorded on the balance sheet at cost and subsequently amortized. If the assets are acquired in a business combination, then under the acquisition method that will be applicable, and we will study it in detail in level 2, the identifiable assets and liabilities will be recorded on the books on fair value. So we'll first calculate the fair value of the intangible asset and then record it at that value after the combination. Any price paid over and above the fair value of identifiable assets is called goodwill, and as we studied that only goodwill created in a business combination is recorded on the balance sheet. Internally created goodwill will be expensed. We've studied depreciation many times before. We'll quickly revise it once again. So it is the allocation of the asset's cost over the periods in which the asset generates revenue. Carrying value of the asset is also known as the net value of the asset, calculated as the cost of acquisition minus any accumulated depreciation. So if I acquired it at $100 and I've depreciated the asset at the rate of $10 every year, then after 5 years, the carrying value will be 100 minus accumulated depreciation of 50, that is $50. The historical cost is the original purchase price, including any installation, transportation, taxes that had to be paid for acquiring the asset. This is also known as the gross investment in the asset. Analysts should be aware that reported depreciation may differ from the economic depreciation or erosion in the worth of the asset. We've studied the depreciation methods earlier as well. So in straight line depreciation, the expense is equal every year, calculated as the original cost minus the salvage value upon the depreciable life. In accelerated depreciation methods like the double declining balance method, more of the asset is depreciated in the initial years. So the depreciation expense every year in the DDB method is calculated as 2 upon the depreciable life multiplied by the book value at the beginning of the year. The book value can be calculated as the original cost minus the accumulated depreciation, also known as the carrying value. So there is no explicit mention of the salvage value in the DDB method, but the depreciation will stop once the asset has been depreciated to its salvage value. One new method that we study, and it's pretty straightforward, is called the units of production method. Herein the depreciation expense is based on usage rather than time. So the depreciation expense is calculated as the cost minus the salvage value multiplied by the units produced in this period upon the total life and output units, or the total units that the asset can potentially produce. So pretty straightforward calculation. Please pause the video here, read the question and solve it. And once you've solved it, go ahead and verify your answer. This is how your income statement should look under the straight line method, under the double declining balance method, and the units of production method. Now, two inputs that go into every depreciation calculation, that is the useful life of the asset and the salvage value of the asset, are essentially estimates given by the management. So the management may sometimes manipulate these estimates in trying to overstate or understate the net profits. So the life of a depreciable asset, or the residual value, that is the salvage value, could be significantly overstated. What this would do is that it would reduce the depreciation expense, as if the useful life is elongated, or if the salvage value is too high, then either the depreciation will be slower or less amount will get depreciated. Doing this, however, would create problems in the future and when the asset is retired, because the actual price that we will get at that time will be lower than the book value, which has been overstated because of our incorrect assumptions, hence causing a loss. Please remember from the review on the income statement that a change in accounting estimate, such as the useful life or the salvage value, is not recorded retrospectively. That is, any adjustments are put into effect in the current period and prospectively in any remaining depreciation. So what this will do is that it will result in a higher net income today in exchange for a one-time charge or lower income in the future. Let's understand this with an example. Banyan Incorporated purchased machinery for $42,000 with an estimate of useful life of 6 years and a salvage value of $18,000. Banyan uses the straight line depreciation method. At the beginning of the 5th year, Banyan reduces its salvage value estimate to $3,000 from an earlier estimate of $18,000. Determine the depreciation expense for each year. Now for years 1 to year 4, the depreciation expense would be calculated using the straight line formula, that is 42,000 minus the salvage value of 18,000 divided by the useful life of 6 years. So we will depreciate $4,000 every year for the first 4 years. In year 5 and in year 6, we will have to revise our estimate since the new salvage value estimate is 3,000. So the remaining value of the asset, that is 42,000 minus 16,000, since we've depreciated it for 4 years at the rate of 4,000. So the remaining 26,000 will now be depreciated more steeply so as to bring it down to 3,000 after 2 years. So the depreciation expense for year 5 and year 6 will be 26,000 minus 3,000 upon 2, that is $11,500. So we see that income in the first 4 years has been overstated because of the low depreciation expense at the expense of years 5 and 6. So if the current CEO or the current management had a 4-year term, then they would have probably enjoyed good bonuses based on the high net income at the expense of considerably lower profits in the next 2 years. IFRS requires firms to depreciate the components of an asset separately. So for each component, we are required to estimate the useful life, the salvage value, and compute the depreciation expense. For example, a factory consists of land, plant and equipment, building, electrical systems, and many other components. So for each component, we need to calculate a separate depreciation expense. Component depreciation is also allowed under US GAAP but is generally not used. So let's do an example. FlySmart Airline purchased a new airplane with an all-inclusive cost of £60 million. The estimated life of the airplane is 20 years, with an estimated salvage value of £7 million. FlySmart expects to replace the interior of the aircraft after 10 years. The component cost of the interior is estimated at $4 million. Calculate depreciation expense in year 1 using the straight line method, both assuming the interior as a separate component and assuming the component method is not used. So if we take the interior as a separate component first, then we will have two components in the airline. First is the airplane with a value of 60 minus 4, that is 56 million pounds, which will be depreciated over 20 years to a value of 7 million pounds, that is the salvage value. So this will be the depreciation expense on account of the airplane. Likewise, year 1 will also have depreciation of the interiors, which are estimated at $4 million and would need to be replaced after 10 years. So the total depreciation expense would be $2.45 million plus $0.4 million, that is $2.85 million under the component method. If we do not assume the component method, then the entire cost of the airplane, that is $60 million, would be written down to a value of $7 million over a period of 20 years, giving us a depreciation expense of $2.65 million. Just like depreciation is for tangible assets, amortization is for finite-lived intangible assets. So let's do an example. At the beginning of this year, Canopy Corporation entered into business acquisition. As a result of the acquisition, company reported the following intangible assets: a patent worth $750,000, franchise agreement, a copyright, and goodwill of $640,000. That is total intangible assets of around $2 million. The patent expires in 15 years. The franchise expires in 9 years but can be renewed indefinitely at minimal cost. The copyright is expected to be sold at the end of 25 years for $45,000. Use straight line amortization, like the straight line depreciation, to calculate the total carrying value of Canopy's intangible assets at the end of the year. So we'll first estimate the amortization expense. So the patent has a life of 15 years. So every year we need to depreciate $50,000 of the patent. The franchise agreement can be renewed indefinitely at minimal cost. So can I say that it has an infinite life? Hence we do not depreciate the franchise agreement because we'll divide it by infinity. The expense is going to be 0. The copyright will be sold for $45,000 after 25 years. So the amortization expense on copyright will be calculated as $10,200. Please remember, goodwill is not amortized, it is tested for impairment. So the total amortization, that is a reduction in the value of the intangibles, would be to the tune of $60,200, or the ending intangibles would be 1.98 million minus $60,200 as $1.9198 million. Now under both US GAAP and IFRS, long-lived assets will generally be carried at depreciated cost. That is the cost minus the accumulated depreciation. However, in IFRS, sometimes we are allowed to use the revaluation model. So the revaluation model permits long-lived assets to be recorded at their fair values as long as liquid active markets exist for these assets so that their fair values can be reliably estimated. firms must choose the same treatment for all similar assets so that they cannot selectively revalue assets that have increased in value and not revalue the assets that have decreased in value. Even though allowed, this model is rarely used even in IFRS reporting firms. However, if you do revalue, then the value of your asset can either go up or go down. Any decrease in the value of your asset has to be recorded in the income statement. That is, the loss arising is recorded on the income statement, but any gain over and above the original loss or over and above the original cost of the asset will not be recorded on the income statement. That is, any subsequent gain will be recorded in a separate equity account called the revaluation surplus. Something like the other comprehensive income that we studied earlier. Now, revaluing the value of an asset upwards will result in greater total assets and greater shareholders' equity. Subsequent depreciation expense would be higher, resulting in lower profitability in periods after the revaluation. However, in the period you do the revaluation, profits and equity will go up. The concept of asset impairment is much more important than of revaluation. So if the carrying value of the asset is $100, let's assume, and a new technology has been developed such that the current plant has become obsolete and the fair market value of this plant is only around $50. In such a case, would it be prudent accounting practice to write down the value of this asset from $100 to $50 so as to give the correct picture to the shareholders and other users? So that's what we'll try to learn in the accounting for asset impairment. So under IFRS, the firm must annually assess whether events or circumstances indicate that an impairment of an asset's value has occurred. An asset will be considered impaired if its carrying value, that is the cost minus accumulated depreciation, exceeds the recoverable amount. And what is the recoverable amount? It is greater of the fair value less net selling costs, something like the net realizable value in inventories. So the fair value minus selling costs, or the selling price minus selling costs, and the value in use. Value in use is the present value of all future cash flows. So either we'll sell the asset or we'll use it. The recoverable amount is the greater of the two values. If the carrying value of the asset is greater than the recoverable amount, then the asset is considered to be impaired. If impaired, we will write down the value of the asset to the recoverable amount on the balance sheet, and the difference will be recorded as a loss on the income statement as an impairment loss. This loss will be below the operating income and is normally considered a one-off. Under IFRS, this loss can be reversed if the value of the asset recovers in the future. However, the reversal will be limited to the original impairment loss. That is, we can take it back up only to the carrying value or original cost. So information related to the equipment owned by MacLife company is as follows. The original cost is $660,000, accumulated depreciation of $50,000, implying a carrying value of $660 minus $50, that is $610,000. The expected future cash flows, please note undiscounted, are $630,000. The discounted back value of these cash flows is the value in use, given to be $560,000. The fair value is $570,000, and the fair value minus selling costs would be $550,000. Assuming MacLife will continue to use the equipment, test the asset for impairment under both IFRS and US GAAP and discuss the results. So we'll do IFRS first, we'll study the US GAAP accounting next. So under IFRS, the asset is carried at lower of the carrying value or the recoverable amount. The recoverable amount here is the greater of the value in use or the fair value minus selling costs. So $560,000 is greater than $550,000. So the recoverable amount is given as $560,000, which implies an impairment loss of $50,000, which will be taken on the income statement, and on the balance sheet the value of the asset will be written down from $610 to $560,000. Under US GAAP, the asset is tested for impairment only if circumstances and events warrant, not annually like in the case of IFRS. The process of impairment is a two-step process in US GAAP, where in step 1 we test the recoverability. So the asset will be considered impaired if the carrying value of the asset is greater than the asset's future undiscounted cash flows. So that's the first test for impairment. If the carrying value is lesser than the undiscounted cash flows, then the asset is not considered to be impaired. If it has impaired, then in the second step we measure the loss. That is, the value of the asset is written down to fair value on the balance sheet. Fair value is the fair selling price today. If the fair value is not known, then we can use the discounted back value of its future cash flows as the fair value. So we test for recoverability using the undiscounted cash flows. If impaired, we write the value down to the discounted cash flows. Under US GAAP, loss recoveries are not permitted. So once impaired, it will remain like that. So let's do the same example again. The original cost, accumulated depreciation, expected future cash flows, and the other details are provided. Assume MacLife will continue to use the equipment. Test the asset for impairment under US GAAP. So step 1 will be recoverability. The carrying value is $610,000. Asset will be impaired only if it is greater than the future undiscounted cash flows. So the future undiscounted cash flows total $630,000. So the carrying value is less than the undiscounted cash flows. Hence the asset is not impaired. So the details of impairment of intangible assets we will study in level 2. But please note that the impairment loss is recognized in the same manner as for tangible assets when the carrying value of the intangible asset exceeds its fair value. So this is done for intangible assets with indefinite lives like goodwill. So the next couple of slides are not very important from the exam point of view, but they are mentioned in the curriculum nonetheless, so we'll go through them. So in accounting for assets held for sale, if a firm reclassifies a long-lived asset from held for use to held for sale because the intention has changed from using it to now selling it, then the asset is no longer depreciated and is immediately tested for impairment. So we don't depreciate or amortize it. The impairment is done in the same manner as studied earlier, but for long-lived assets held for sale, the loss can be reversed under both IFRS and US GAAP, which was not allowed under US GAAP earlier for assets held for use. Property, plant and equipment, intangible assets need to be de-recognized when either the asset is sold or it is exchanged or abandoned. In either case, whatever we receive from the asset or the sale proceeds minus the carrying value will be recorded on the income statement as a gain or loss. This gain or loss is reported below operating income as a part of other gains and losses and is considered a one-off. So apart from the quantitative value of the assets, both US GAAP and IFRS require other qualitative disclosures to be made about the long-lived assets. So you don't have to memorize these disclosures, but just browse through them once and know that these are some other details that the management needs to disclose about the assets that it's carrying on its books. Similarly, US GAAP has its own set of qualitative disclosures that must be made. Now, IFRS presents one more classification of long-lived assets as investment property. So this is a property that a firm owns for the purpose of collecting rental income or earning capital appreciation or both. So if the property is an investment property, then the firm can use either the cost model or the fair value model to account for the property. US GAAP does not distinguish investment property from any other property. In the fair value model, the investment property can be carried at fair value provided that the fair value can be reliably established. The cost model is the same as that for other long-term assets. The only difference between the fair value model from the revaluation that we studied earlier is that for investment properties, A revaluation above original cost or historical cost can also be recognized as a gain on the income statement, or rather is recognized as a gain on the income statement, which is not allowed. We had a revaluation reserve in the asset revaluation model. So that was about the accounting guidelines for long-lived assets. Please make sure you practice a lot of questions and be comfortable with all the guidelines. We'll start with a very interesting review on income taxes in the next session. Thank you so much. See you next time.